Well, good afternoon, ladies and gentlemen. Thank you for taking the time out of your busy schedules to join our quarterly update for today. The presentation will begin shortly, so I will be the moderator of the webinar alongside Brian. We're putting everyone on mute as soon as the presentation begins, but please feel free to ask any questions in the chat and we'll do our best to answer them for you. The webinar is being recorded. The recording will be shared on YouTube and social media channels afterward. If you have any questions, please put them in the Q&A. Just before we start, a few disclaimers to go through for compliance, if you just bear with me. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and unless otherwise stated are not guaranteed. So please be sure to first consult with a qualified financial advisor and or tax professional before implementing any strategy discussed herein. Perfect. Okay, so again, welcome. Thanks for coming. I guess just starting off from the very beginning, it's no secret that artificial intelligence has become the talk of the town lately, captivating our imagination and reshaping various industries.
Absolutely, Josh. Well, all CEOs seem to be talking up everything AI. We've had top buzzwords in the past and the near present, words like the metaverse, DeFi, NFTs, blockchain, and cryptocurrencies. And we should all take these all with a grain of salt because essentially what we've seen is a reversion to the mean. Why they got hyped up, those stocks kind of shifted up and then they reverted right back to the mean. So question for you, Josh, question for the audience. Anybody know what the best performing stocks were last month in June?
Yeah, let's see if we can get some answers going in the chat. So what did we think, without cheating, I guess, by looking too much at what you see on the screen, but yeah, let us know which positions that you thought performed really well up to now, given what we've seen in the year so far. Let's see if we can get some answers going. I know that I heard a lot of noise about Tesla, which I know you can't see on the screen, but I know that that was what some people were suggesting as kind of having a rebound from last year, which I guess is going along with sort of what we're talking about today. Let's see if we get any.
We'll kind of jump right in there because I don't think anybody's going to actually get these correct, because essentially what we've seen is some of the biggest losers after the last couple of years have been the biggest gainers in the last month. You know, Carnival Cruise Lines, Norwegian, Delta Airlines, Royal Caribbean, all right up there in the top 10, i.e. people are getting back out there and going on vacation. So we hope that you're going someplace nice on vacation, so that essentially things can get back to normal. But they haven't been the biggest earners in the S&P 500. They're individually the biggest earners. Most of the actual earnings this year in the S&P 500 come from the 7 big tech giants because they make up the biggest portion of the sector. So essentially, that's really where the concentration lies because they're the biggest positions in the overall portfolio. Move forward.
Yeah. All right, so just kind of following on from that, we're starting from the beginning. So what exactly is going on here on the wider scale of things, Brian?
Well, on a global picture, we're still talking inflation. It's all about inflation, except for unlike last year where inflation was universally going up across the board. Everybody was having problems with inflation. We were basically now getting diverging fields. Why I say we've got diverging fields is the United States looks like they have inflation under control. It's at 4% now. So when we have 4% inflation, that's kind of long-term averages when it comes to inflation. Europe, Canada, Australia seem to be getting it under control. It's coming down. The United Kingdom is the only developed country that doesn't have downward moving inflation, which is quite scary from that vantage point. But then if we go over to China, there's a lot of comparisons that it looks a lot like Japan did the last couple of decades. in which they can't actually impact any inflation. So essentially, we've got a diverging world where everybody's going in different directions. The best example of this can be shown from the US Bureau of Labor Statistics. It's basically been a decline driven by energy prices. So you see right in the middle right here, or kind of upper middle, commodity prices have been dropping significantly when it comes to gasoline, fuel oil, and the such. And this can make up to 15% of overall inflation. And it's a little bit of a leading indicator of what the rest of inflation will come into because we use fuel, we use energy to basically produce anything overall. So essentially, we'd expect when energy prices are going up, that inflation will start to go up. When energy prices go down, it will continue to be driven down going forward. And so this is a good indication for all of us.
Okay, so what exactly does this all mean with regards to what we're seeing? I know inflation's been a big story, but how do we tie this all into what we're seeing now?
Well, essentially, the biggest way that you control inflation is through interest rates if you're a central bank. So now central banks, America has been the most hawkish. They've basically tried to control it the most by raising rates. And so they have the highest rates. And then across the board, everybody else has been lagging a little bit behind. Now, Turkey caught up significantly last week. So there we see them kind of going through the roof. But the Federal Reserve in the United States has paused over the summer. Powell is not saying that he's stopped raising rates, but for the year, but he's paused for the year. And Europe and the United Kingdom are playing catch up now. So we can see them on the tail ends. Now, it might be a little bit easier to look at this chart where we've essentially ranked from top to bottom the lowest interest rates all the way down to the highest interest rates. And essentially, we've put the United States as our benchmark. So it's the interest rate differential that becomes important. Now, this is important because it quantifies where the carry trades might shift.
And just as a refresher for those unaware, can we explain a bit about what a carry trade actually is?
Well, the carry trade is what really drives currency markets. And it's essentially a financial strategy where an investor will borrow in one currency in one country, and then they'll invest the funds in another currency. So for instance, if we take Japan, if you're able to borrow money pretty much for free, negative 10 basis points, and yet you invest it in even short-term US treasuries, and you're getting 5 1/4, essentially you're borrowing at zero and you're getting paid 5 1/4 to have that money invested. So that is where the shift of money goes, and that's what devalues certain currencies and increases other currencies.
All right, great. So just tying all that into what people can expect in terms of their overall financial plan or portfolio, basically with all the interest rates being what they are, what does this all mean from that sort of vantage point?
Well, essentially, your fixed income is finally going to have the opportunity to be invested in the currencies that you're living and needing the funds. We had years and years where we had even negative interest rates in Europe and extremely low interest rates in the UK. So fixed income had to stay in the US, where not only was the dollar strong, but interest rates were a little bit higher. Now, if European and UK interest rates catch up to the United States, we can eliminate currency risk by owning our fixed income in that currency. So if we go back to this last slide, if we're looking at the United Kingdom, we're at 5% interest rates versus 5 1/4 in the United States. So we can start to buy gilts instead of buying US treasuries, and we've eliminated any currency risk for that portion of the portfolio, which is extremely attractive. Now, On top of that, we don't have to look at exotic instruments like preferreds, high yield fixed income, or convertibles so significantly. Instead, we're able to buy boring, tried and true bonds, which eliminate some of the risks in our overall portfolios because of these higher interest rates. And that's essentially going to be lifting the performance in our portfolios while reducing our actual overall risk exposure. Now, as interest rates increase, we expect there to be a true decline in the US dollar. And we've really seen this. Now, this is a little bit of an inverted chart if you look through it, where you can see a good decade worth of performance where the dollar was going up and each of these respective currencies, the British pound on top, the euro second in orange, blue is the Australian dollar, and then the Canadian loonie in green. But you can see that essentially those currencies were going down and therefore the dollar was going up all the way until October of last year. And then you had a sharp increase. And that was because of the interest rate moves, making it more attractive to start to invest in these foreign currencies instead of the domestic US dollar. That will continue as the US stays paused on interest rates and other currencies go beyond those interest rates, catch up to them and then go beyond them. And that will actually move those currencies abroad.
So I guess real quick, just if the line going down means the dollar is stronger against that currency, going up, it means that currency is stronger against the dollar.
Exactly.
And what did you call the Canadian one? I never heard it called that.
It's the Canadian loonie.
Why is it called?
That is literally the nickname for the Canadian dollar.
I didn't know that. Okay,
Learn
every day's a
something
school
new.
day. So there you go. Okay, so why should I care is the next big question I think a lot of people have on their mind.
Well, we really covered the first part, which is the fixed income side of our portfolio. We care about that because that is going to be our risk-free money. But a lot of our portfolio is going to be invested in equities, and it should remain invested in equities. And the biggest portion of equities are in the United States. So we're going to just look at the demographic of the S&P 500 because it's the most famous and the biggest index in the world. And the geographic exposure of the S&P 500 is literally that their revenues, 60% of them come from the United States, but 40% of them come from abroad. So if the dollar goes down, that 40% that comes from abroad is actually adding a larger net benefit to our overall portfolio. Depending on what sectors you're invested in, it might be more or less. For instance, utilities, most of their revenues naturally come from the United States. But when we go to information technology, so anything in the IT sector is inverted. Nearly 60% of their revenue comes from abroad and only 40% domestically. So if you have those big seven names, that declining dollar got significantly helped by a declining dollar, and that helped the S&P 500 grow. Essentially, what we're saying is a declining dollar is going to be good for the S&P 500, and the S&P 500 is the biggest market share of stocks in the world. We've had this inverted yield curve. Josh talked about this quite a bit. To remind you, the inverted yield curve in simple form just means that you're getting paid more in interest to own a short-term bond instead of a long-term bond. Essentially, the bottom line is essentially 2 years ago what the yield curve looked like. Now, that yield curve essentially is quite normalized in that way because if you lent somebody money for a short period of time, you got paid a small amount of money. If you lent them money for 30 years, you got paid a larger amount of money. Now, we've been going on for 9 to 10 months of having an inverted yield curve, which is up top, where we get paid more to have a short-term interest, a short-term bond instead of a long-term bond. And this is typically the precursor to a recession, but it's not a precursor to a recession. It's typically causes a recession because naturally, if it costs banks more to borrow money than what they're able to lend it out on the long term. They're not going to lend money on the long term, which essentially slows down the general economy. Now, that's a little bit of a repeat of what we've been talking about for the last 10 months. The good news is we're starting to see it improve. So for instance, 5-year bonds last month alone increased by 39 basis points, so 0.39%, whereas 1-month bonds declined by 4 basis points, so 0.04%. So the short term's coming down, the long term's moving up, and pretty soon, hopefully, we'll be uninverted, and that will be a show of more prosperity for the future as banks can normalize and lend again in more mass form.
Okay, so that's a bit about fixed income and what we can expect going forward, but kind of switching over to the more equity-driven side. Earnings haven't been great for the beginning of the year, but it seems like the expectations for the rest of the year are quite strong. So I guess we'll talk about what the implications are for that and what exactly that means, digging a bit deeper into what we mean by earnings.
Well, in my mind, to simplify things, there's 2 types of earnings. There are good earnings and there are bad earnings. Now, good earnings are essentially our company made more revenue and therefore we made more profit at the end of the day. Right? There were more sales along the way. Now, the thing is, we know we're having a slowdown. We know our economies are contracting. There's no doubt about that. Now, why are there such good expectations of earnings growth closer to the end of the year? Simple. We're looking at bad earnings. Bad earnings come down to essentially lots of redundancies, lots of cutbacks, less investing, and therefore more profitability. And that's what we're looking at close to the end of the year. We've already seen 250,000 jobs lost in Silicon Valley, amongst the Silicon Valley firms. But essentially, we're starting to see it moving into other sectors. We're starting to see bankruptcies. We're starting to see essentially big real estate transactions where people are moving out of certain areas. And that is actually enhancing earnings. So what we'll remind you is while there's a lot of talk of a recession coming, the S&P 500, the stock market is not necessarily a perfect representation of the overall economy. Nearly 85% of the people employed in the United States alone work for non-public companies. So these public companies are going to have different leading factors other than just what the general economy is doing. And that's why there's expectations of such good earnings near the end of the year. Now, when it comes to earnings growth, it shifted from last year's mentality. Last year, essentially, everybody went into energy because oil prices went through the roof because of Russia invading Ukraine. Now, all of a sudden, oil prices have come down. They're tempered. That's impacted the beginning of the story where we were talking about inflation rates being so high. But it's also getting hit by this double whammy, which is from the ESG sector. We've basically seen so much come into clean energy investments over the last several years, as can be demonstrated from the light blue, that essentially oil is no longer that new frontier. It is the old segment. And this year, what we're really seeing is more investment in solar generation, not overall clean energy. We're talking about just solar than there is in new oil production. So we know exactly where the industry is going. We just don't know how long it will take for that oil production to become more de minimis. What I'll remind you about is during this entire time period, what we've really seen is we've seen essentially more energy usage because of the emerging world coming online and using more energy, and yet still more energy is produced through clean energy than dirty energy. So positive vantage points and positive attributes to investing in that arena. But On the nearer term, as you've probably seen in our newsletters, we've started publishing what's going on in the overall markets in these quick little fact sheets. So here's kind of a little bit of a quick and dirty. We've basically got across the board good returns. And those good returns, those positive returns are coming in emerging markets, in domestic markets, and in other fixed income markets. And this is more of a recovery from the horrendous returns last year. As you can see, growth has done better than value. Last year, value was the better performer, but growth had more room to recover than value. Even when it comes down to real estate, it's been a lot of talk of, will real estate be able to survive the higher interest rates? Our one-year numbers are still negative on real estate, but year to date, we're still getting a nice little rebound when it comes down to it. The last month, small cap has been the big ticket and the big performer across the board, but everybody's portfolios are more significantly weighted to technology than we've ever seen before. Hence the large recovery, because technology has been the biggest performer, and it's got the biggest weighting in the S&P 500. So we should be very, very comfortable with the fact that we're rebounding from last year's dismal numbers. Doesn't matter if we're talking fixed income, real estate, or the equity markets. And that gets us to our periodic table of returns. The periodic table of returns really just gives us our rhyme and reason why we want to make sure that we're diversified. These are all the positions that we have in all of our different model portfolios. At the top is the top performer. The bottom is the bottom performer for that quarter. And each time frame is the time span. So going from left to right is basically 2019 all the way to this last quarter. And what you'll notice from the color molds, there's no reason to try to chase different portions. We're going to perform better by having a diversified portfolio and trying to move forward in small tranches instead of just trying to hit a home run every single time. The simple updates to the portfolio: we're moving our fixed income more to our relative currencies. We haven't made all the moves just yet because we're wanting to get those interest rates at those higher levels, the same levels as what we're getting domestically. And the growth inside of our portfolio is really coming from the tech sector rebounding instead of it being an overall great moving market. The downward dollar is going to help us instead of hurting us, so don't be scared of those vantage points.
I like that final sort of quote we have, I guess, because yeah, that's if you're not familiar with Billy Beane, that's from the film Moneyball, also from a certain baseball team of mine that's not going to be in town in Oakland, a bit further on, but hey ho, it is what it is. Now, I think what we'll do at this point is just open it up to any of the questions. So like I mentioned at the start, any questions you have would be great if you could just put them in the Q&A. You can also put them in the chat, and we'll just handle the questions as and when they come. But I think, yeah, we'll turn it over to that and just see what we can hear from you guys about where you want to learn a bit more about today.
So why don't we pick on a little bit on the real estate market? The real estate market here in the UK has been quite interesting. The last couple of months, we had 2 months in a row where we had declines. This month, essentially, we got a surprise that we saw growth in pricing at 0.1% year over year. But naturally, there's a delay when it comes to any of these home sales. And typically, what we first see is a decline in sales before we see a reduction in prices. and we're definitely seeing that decline in sales, the decline in mortgage products and the likes. Interest rates are not going to impact the overall real estate market as much as we would have expected, because only 30% of individuals here in the UK actually have a mortgage. Most houses are paid off. But if it shrinks sales and if it slows them down, then it can slow down the market in the same way. So sometimes it might be a little bit more prudent to wait for any real estate purchases instead of to jump right into them.
Mm-hmm. Absolutely. Okay. All right. Question is, Nala seems to have a lot to say today. Does she agree or disagree?
I think she's agreeing that there's a pot full of treats right here. So forgive us for anybody that doesn't know who Nala is. Nala is the firm dog, and she's the one that's been making all the whining noises today. Sorry about that.
I'm not sure what insight she has about the real estate market anyway. All right, let's see. Let's see, what else can we go over here?
If you have any questions that you want to send over, you can send them over right now. Otherwise, feel free to drop us an email anytime. You know exactly where to find us. We're going to go through a few months of hopefully a boring market. That's what we're hoping for this weekend. That's what we were trying to insinuate with the newsletter yesterday. Essentially, this boring market is really it's proved itself based on the mutiny that went on in Russia last weekend. If that couldn't move the markets, I don't know what could move the markets. I see that as good news. Well, the UK introduced price and income controls to augment interest controls to try to tame inflation. That's a great question, Richard. I can't see this government putting that into place when they can't control many of the factors that are involved there. I think they have a strategy of hope right now, and it might lead to more desperate measures by the Bank of England. As we've heard from many of the members of the Bank of England in the last couple of weeks or couple of months. So I tend to think that it is going to be a little bit more rampant for a longer period of time. It's brought about a lot of conversations that have come about. Some of the price controls can come into places like the utilities markets with Thames Water coming into some administrative problems. That will be easy for them to control things from that vantage point. But across the board, that's not really the temperament of this government at this point in time. We thank everybody for joining us today. Like I said, please do reach out if you have any questions, big or small. If you agree or disagree with anything we have to say, we look forward to continuing the discussion.
Right, well then I think that concludes everything, but thanks everybody for attending. We'll get a recording of this up on YouTube. In the meantime, hope everybody had a great 4th of July, and we look forward to hearing from you.
Thanks everyone.
Thank you.